In this video, we'll examine the development of the price-earnings ratio using single exponential smoothing for earnings, or PE-SES. We'll show the advantages of this approach and the implications for real stock market returns over the next 1 to 25 years. Development goes back to the father of value investing, Benjamin Graham, who taught looking at earnings over multiple years would give a better indication of the intrinsic value of a stock than looking at a single year of earnings. A PE ratio using a single year of earnings has a poor correlation with future stock market returns. Here is a chart of earnings of the S&P 500 and a calculation of what the earnings would have been for stocks if the methodology of the S&P 500 had begun in 1871. In the last two recessions, earnings fell faster than stock prices. The PE ratio using the last 12 months of earnings showed the stock market to be expensive, even though it was cheap and close to the bottom of the cycle. Using estimated future earnings can work well during economic expansions, but typically fail at the worst time. Earnings usually rise at double-digit rates during expansions. Estimates of future earnings also rise at double-digit rates and usually continue estimating double-digit growth for periods that turn out to have double-digit earning declines. Graham's advice of using several years of earnings to estimate the current intrinsic value of a stock solves this problem. But using multiple years creates an inflation problem. Inflation or deflation means a dollar of earnings here is not the same measure as a dollar of earnings here. Robert Shiller of Yale fixes this problem in his cyclically adjusted price-earnings multiple by adjusting earnings and the S&P 500 price for inflation. He uses a 10-year moving average of real earnings and the real price. Here is the CAPM calculated using the real price and real earnings over the previous 10 years. Back in the chart of real earnings, the 10-year moving average can have a tail wagging the dog problem. For example, from 1922 to 1929, earnings were moving up strongly, but the 10-year average was falling through 1928 because strong earnings were falling out of the average. Bob Bronson fixed this problem using single exponential smoothing, where each data point is weighted exponentially more than the preceding point. In single exponential smoothing, each point of smoothed data represents all the data up to that point. A smoothing constant is applied to each new data point. In this example, the smoothing constant is 0.1. The new data point is multiplied by 0.1, and the previous smoothed data point is multiplied by 0.9. So in the new smoothed data point, the last point of new data has a 10% weight, and all the previous data is weighted at 90%. One must also pick a point to start the smoothed data from. To smooth real earnings, I use a 0.002 smoothing constant. This makes the exponentially smoothed line smoother than a 50-year moving average. Starting from 1.6 makes the best fit growth rate match that of the actual data. Even with several times the smoothing, the exponential line responds faster to a change in trend than the 10-year moving average, since new data is weighted exponentially more than previous data. Here is the PE-SES since 1871. It is similar to Shiller's CAPM. You might notice that since 1996, when Fed Chairman Alan Greenspan described the stock market as irrationally exuberant, valuation has averaged about twice as high as it did before 1996. At this time, it's unclear whether this is a new normal and will persist, or if it is a super bubble that could deflate suddenly or over a few decades. Measures of valuation have very little predictive ability of what will happen to stock prices in the short term, but can have useful insight into the return over long periods. We will look at correlation for periods from 1 to 25 years. This chart shows the relationship between the PE and the following one-year return. The scatter plot on the left shows the same data as the time series plot on the right. For example, the 12 months from July 1932 to July 1933, the stock market returned 157%. The PE-SES was 7.5 in July 1932. This scale for the PE matches the best fit line. The best fit line slopes down, showing that a higher PE tends to be followed by weaker returns. So this scale is inverted. The slope is shallow because it has a low correlation. R squared can range from 0 to 1. This 0.04 suggests that the PE at the beginning of the year explains 4% of the variation in real stock market return over the next year. The tightness of this scale matches the low correlation of the relationship. The correlation of the PE with a 2-year period more than doubles to 0.09. The best fit line is steeper. The annualized return scale has a narrower range. This scale is not as tight. The PE in June 2017 was 52, and the 2 years, June 2017 to June 2019, annualized returning 8.4%. The PE of 55.2 in June 2019 estimates the 2 years to June 2021 will annualize losing 2.6% after inflation and dividends. In looking at longer periods, the correlation and length of period grow together, while the range in the annualized return and its scale get smaller. What started out at minus 100 to 200 is now down to minus 10 to 20. At 10 years, the correlation is almost 10 times stronger than at 1 year. The 55.2 PE-SES in June 2019 suggests the 10-year period ending in June 2029 will annualize losing 2.8%. In his book, Irrational Exuberance, Shiller shows the cyclically adjusted price multiple with a 10-year period of return. The R squared of 0.31 is weaker than the 0.38 using the PE-SES. The correlation continues to grow with the length of period. The strength of the correlation used to reach its peak with an 18-year period, but the data since 2013, shown in red, has dropped the R-square from 0.65 to 0.51, as the high valuations since 1996 worked their way into 18-year periods. Now the strength of the correlation continues growing out to the 22-year period. Here, the all-time high PE-SES, estimated the 22-year period ending in December 2021, will annualize losing 5.1%. This would equate to a 68% drop from December 1999 and about an 84% drop from mid-2019. However, if valuation continues at the elevated post-1996 levels, this dire forecast will become inaccurate, just as the dire forecasts using 18-year periods did a few years ago. The correlation gets slightly worse going out to 25-year periods. The theoretical advantage of using the PE-SES is borne out in actual data with superior correlations to future market returns over the CAPM at every period from 1 to 25 years. For updates and further insights on market valuation, follow me on Seeking Alpha.